first meeting of the Bank of England's Monetary Policy Committee, or MPC, is likely to be the focal point for economists this week. Governor Andrew Bailey will announce the latest decision on interest rates and quantitative easing, or QE, on Thursday the 4th of February. Mr Bailey and his colleagues seem to be doing a bit of a hokey-cokey on the subject of negative interest rates, a situation which could mean you'd be charged for keeping your money in the bank. The MPC is investigating whether negative rates could boost the economy by persuading savers to take their cash out of the bank and spend it or invest it. They'll also be interested to determine whether negative rates could encourage more borrowing by consumers and corporations and therefore potentially more spending. It also perhaps help the government with its interest bill on its total borrowings, which have now frighteningly topped the £2 trillion mark. But the San Francisco Federal Reserve of America produced a paper last year which just buried the concept of negative interest rates, saying there was a case to be made that they did more harm than good. Negative interest rates don't seem to have done much to help Japan's economy, at least. They will hammer banks' lending margins and profits, and therefore potentially banks' ability and willingness to lend, hampering in turn rather than helping credit flow. And there's also the risk that people just stick their cash under the mattress. In addition, negative interest rates could prompt a speculative bubble in financial markets, as investors feel compelled to do something with their cash, or at least prompt malinvestment and waste of money in projects that would never get off the ground if there was an actual cost of money in the first place. Now, we shall see, but for the moment, the Bank of England's headline base interest rate is 0.1%, and the QE bond buying programme so far has come to £895 billion, that after the £150 billion increase last November. Company news flow is going to be plentiful in the week ahead. Around a dozen of the FTSE 100's members will produce results or a trading statement in the coming week, and a good number of small and mid-caps are due to do the same. Names which may be worthy of further research include the following, although please note that these dates can still be subject to change. BP, SSE and Virgin Money UK on Tuesday the 2nd of February, Glencore and Vodafone on the 3rd, and then a bumper day on Thursday the 4th, with Royal Dutch Shell, BT, Severn Trent, Unilever, Compass and Barratt Developments. But for all of those, the name that perhaps could cause the biggest fuss in the week ahead is pharmaceutical giant GlaxoSmithKline. It's due to report full-year results on Wednesday, the 3rd of February. The shares are down by a quarter over the past year, twice as bad as the FTSE 100's 12% slide over the same time frame. And in fact, GlaxoSmithKline ranks 85th in the FTSE 100 in terms of its share price performance over the last 12 months. Now, this seems a bit odd when you consider the rush to defensive stocks as the pandemic broke just under a year ago, and that GlaxoSmithKline is the world's leading provider of vaccines. It has a 30% market share and produces and distributes around 2 million vaccines a day worldwide for everything from meningitis to whooping cough and from hepatitis to flu. Now, possible reasons for this turgid share price performance include the company's recent pedestrian earnings and dividend growth profile, of which more shortly, some lingering concerns among analysts about weak dividend cover, to which we'll also return, and also disappointment that the company seems slow off the mark in the race to beat COVID-19. GlaxoSmithKline is working with France's Sanofi on a vaccine, but the pairing admitted to disappointing trials back in December. A new study will begin in February, with a final trial in the second quarter and regulatory submissions in the third. Should all go well, the vaccine could then be available later this year. But that's well behind the treatments from Pfizer-BioNTech, Moderna and Oxford-AstraZeneca, for example. Analysts will look for an update on the COVID-19 vaccine, but when they look at the full year results, they'll go straight for three headline figures. The first is sales, as this will indicate how GlaxoSmithKline's new drugs are helping to compensate for the loss of patent protection on older ones. In the third quarter, sales fell by 5% on a constant structure basis, and by 3% including structure changes but excluding currency movements. Note how momentum's tailed off in the past 2 quarters, and the company's attributed this to COVID-19, as visits to doctors and hospitals were limited to patients owing to lockdowns. Now, including structure changes but excluding currency movements, third quarter sales at pharmaceuticals were down 3% year on year, vaccines rebounded to rise 9%, and consumer healthcare rose thanks to a deal with Pfizer, but excluding that, sales actually fell. Now, this chart shows the constant currency progress since Q1 2017, just before Chief Executive Emma Walmsley took over. The second key number to watch is earnings per share. At the third quarter stage in October, Emma Walmsley forecast that adjusted earnings per share, or EPS, will come in at the lower end of the forecast range of down 1% to down 4% for the year. That's against last year's 123.9 pence a share. Analysts are looking for adjusted EPS of 116p for the year that's just finished. Just as important will be any guidance for 2021, when the current forecast is for pretty much flat adjusted EPS at 116.4p. Hence the earlier point about analyst concerns over GlaxoSmithKline's pedestrian earnings progress as the market waits for pipeline and strategic developments to turn into profits. Finally, investors and analysts will look at the dividend, where an unchanged fourth quarter payment of 23 pence a share is expected, making for a full year payment of 80 pence a share. Now, GlaxoSmithKline's not increased its dividend since 2014, and earnings cover for the dividend is lower than ideally at around 1.5 times, at least based on consensus analyst forecasts, even using the adjusted EPS numbers. A cover ratio of 2 really would give a little bit greater comfort. Now, on a more qualitative basis, analysts will look towards the pharmaceutical and vaccine bases and their pipelines. Some of GlaxoSmithKline's best-selling drugs, again, going off patent, Advair being a key example, and that's now facing generic competition, so sales are falling there at the bronchitis treatment. HIV treatment, Trumec, now generates more revenues, and the company will be looking to show that its new products are selling and it's got plenty more in development for good measure. GlaxoSmithKline's pipeline of new drugs is filling. It's got 40 medicines and 18 vaccines in development from phase 1 to phase 3 trials, and analysts will look for progress reports here and for any new product filings. In addition, analysts will look to updates on 4 drugs in particular: their shingles vaccine Shingrix, HIV treatment Juluca, both already on sale, and cancer drug Zedula and bone marrow cancer treatment Blenrep, both of which received regulatory approvals in calendar 2020. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again all next week.